Hey, this is attorney Elizabeth Potts-Weinstein, and today we're going to be talking about who cannot be an S corporation. So an S corporation is a special type of business tax status according to the IRS, the Internal Revenue Service, which is our tax service in the United States. Now, the weird thing is you can be an LLC that's taxed as an S Corp, or it can be a corporation that's taxed as an S Corp. In both those situations, you get the benefits of being an S corporation. I'm not going to go into the benefits right now. That's a topic for another video. But what I'm going to talk about is who cannot do the S corporation tax status, because it's not appropriate or allowed for every kind of business. The number one situation that my clients run into of who cannot be an S Corp is if the owners are not on the allowed list. Where it tends to come up the most is if you're not a citizen of the United States or a permanent resident, a green card in the United States, you can't own shares of an S corporation. So this means that the owner cannot be an individual who's a non-citizen who resides outside the United States, and it can't be another corporation. It has to be an individual. There are certain types of trusts and estates that can own shares in S Corp, but it cannot be another corporation or business. The second situation is in the number of people who own the S Corp. I don't personally run into this very often, but it's something to think about as you scale up, or if you're going to bring in your employees to co-own the business. An S Corp can only be owned up to 100 people. So for a lot of people starting a brand new business, this isn't an issue. It tends to be when businesses get bigger and they're bringing in some kind of employee stock purchase plan type of program for their employees. At a certain point, you can't do that anymore. You have to switch over to being a C Corp. The last situation, which comes up a lot, is that an S corporation can only have one class of stock. So what do I mean by that? Is that everybody who owns shares in that corporation has the same voting rights. Your voting rights are based typically on the number of shares you own or the percentage of the business that you own. One of the things that can happen is if you start a business and you're doing all the work in the business and you have an outside investor, your rich aunt gives you $100,000 to help you start this business, and she owns part of the business because of that, you don't want her to come and randomly make decisions about the business. You want her to just be a passive revenue person where you give her profits in the business, but she doesn't get to decide what's going on a daily basis. In that case, you're going to want different classes of membership or shares in the business that have different voting rights, where she doesn't get to vote on the day-to-day aspects of the business. Sometimes also there's going to be preferred shares in a company because an investor, they want to get their paid profits first, whether the business sells or just the profits on a annual basis. And so they're only going to give you that $100,000 if they get profits first. They don't care about running the business on a day-to-day basis, but they want their money. So in that case, you're going to need different classes of shares. The short version is if you're having outside investors, who are passive revenue investors, an S corporation is probably not the right choice for you. Again, this is attorney Elizabeth Potts-Weinstein. If you have any questions about whether you can have an S corporation, feel free to ask them below and I will try to point you in the right direction. Thumbs up if you found this video helpful, and subscribe if you'd like any more videos for small business owners and entrepreneurs. Thanks a lot for watching. Bye-bye.